This John Lothian News video is sponsored by
Now that clearing is mandatory for categories 1 and 2, are we seeing a collateral shortage?
It'll be a growing trend because the higher margin requirements for a clear trade will only grow basically in relation to the number of open positions you have in a cleared book. And just because if you started trading cleared derivatives on Monday, you might have only traded one or two, but it's over time if you backload new trades into the cleared model, or if you transact more trades in a cleared environment, that's when you'll start to see the collateral requirements grow versus what they would have been had they remained bilateral.
How are firms responding to possible collateral deficiencies?
In terms of the collateral shortage, I've seen estimates everywhere between 800 billion and 16 trillion in collateral shortages, or something right around there. But the point is, I don't think anybody really knows, because what happens is, as collateral requirements grow, it changes the way people behave. So you're going to see certain participants, because of the higher collateral requirements in an OTC trade, will move to a futures trade that has lower collateral requirements. And in other cases, you may see actually market entrants who are used to futures and never traded bilateral swaps say, you know what, now I'll start to trade cleared swaps because I understand how they work. So you really can't tell to a specific dollar amount, I think, what the collateral shortage is going to be. And I think more importantly, it really doesn't matter, because it's really based on what your firm holds. If your firm and your portfolio holds a lot of treasuries, you'll probably be okay, because your treasuries are going to be generally eligible collateral. But if you hold corporate debt, you might, or equities, you might actually have a shortage, even if the collateral overall industrial collateral shortage is much lower. You'll be more heavily impacted because you just don't hold what would be eligible collateral.
Are you seeing a migration from bilateral to standardized derivatives contracts?
One of the biggest trends in the market is the futurization of swaps. It's the move from the OTC world into the ETD exchange-traded world, and I think it's real. Based on the clients that we've talked to, a lot of them are looking to do this for a number of reasons. One is it's less expensive from a margin perspective. Number two is they already have futures brokers, and they may not have an OTC clearing broker just yet, and there may be a lot of reasons why they don't. So they might actually only be able to trade futures and not clear derivatives. There's some impacts to that, right? There's the fact that now you're dealing in a standard product with standard cash flows and standard dates, so you may not get the hedging that you did before. So you have to make a cost-benefit analysis. Does it make more sense to go with a future and a less perfect hedge, or a more expensive OTC derivative and go with a custom-tailored hedge?
Omgeo and Celent recently conducted a survey on maximizing collateral advantage on the buy side. What did you learn from the study?
We actually found out that there's really almost two camps. There's a camp that was very proactive in preparing for clearing, and they're actually approaching it as how can they clear in a new environment and then take advantage of or thrive in this new environment. And there's the others that were a little less proactive clearing and are looking just to meet the clearing requirements, and have yet to really think about how can we actually have a competitive advantage in this new market.
What are you seeing in terms of buy versus build among collateral management systems?
As things become more complex, we're seeing firms look to either outsource just the technology or outsource the operations and build less in-house. Now, some of the firms do have some large, fairly complicated and sophisticated collateral management systems in-house, but there's definitely a trend toward either outsourcing the technology or the actual operations. And to me, that makes sense, right? Because if you're a service provider, you have a number of different clients utilizing your service or utilizing your system, and you can spread the cost of enhancements. You can take advantage of the ideas across all of your client base.
What is the next step in terms of post-trade efficiency?
If you look at the way we handle the post-trade process in the future space, there's a lot of manual processes and there's a lot of point-to-point communication. So there's an idea here that we should all coalesce around a single standard in the communication of the post-trade world in the future space that seems more important as the volumes continue to rise. So if you look just 10 years ago, 2003 to now, we've seen futures volumes increase dramatically. And I think with the futurization trend, we're going to see the growth rate actually increase. And so we have to really take care of how we handle and how we manage the post-trade environment in order to keep risk out of that portion of the life cycle.